Hey traders, welcome to the Raghee Report. Great to see everybody. Happy Sunday. I hope everyone's doing well, relaxing a little bit before yet another trading week ahead. All right, so as always, we are here to recap, actually review what's coming up this week, take a look at any questions that you might have, as well as talk about what are those events that could put some interesting trades into play this coming week. So let's get to it. We always want to start with the economic calendar, gang. We're going to talk about two calendars here because, frankly, last week, a kind of minor event, this was a Raphael Bostic, FOMC member Bostic event, really upended the intraday day trading setups. And I thought, you know what? Let's make sure we're all on the same page. I'm going to go through the Forex Factory calendar first, and you'll see going into tomorrow, we have FOMC member Jefferson speaking. There's a lot of new names, gang, by the way, on the FOMC roster. And so some of these, they're a little bit less well known. We don't really know which side of the hawkish or less hawkish scale they may not be on. So they have the ability to surprise the market. Got Jefferson tomorrow at 10:30, which is going to affect our day trading morning, my favorite hour or so of the day. Going into Tuesday, looking specifically at red hot zones like the CB consumer confidence number and any FOMC members. All right, there's FOMC member Goolsby speaking on Tuesday. Scrolling into Wednesday, pretty quiet until, of course, we see the ISM manufacturing PMI. That's an important inflation number, gang, even though we wouldn't normally consider it sort of an inflation number per se, but it does impact the broader averages in that way. So we're free of FOMC speak, but we do have a hot zone by way of that PMI. Member Waller is speaking on Thursday, and we have ISM services as well as another new name, Logan, on Friday. So it really makes sense. And usually what I do in my trading planner, my trading journal, is I'll put on those particular days, okay, this time, this speaker. Now, I'm jumping over to trading economics here. And on trading economics, the reason I bring this up is sometimes we'll see the overlap like Jefferson, but sometimes we'll see FOMC speakers that are not listed on the Forex Factory calendar. They'll be here on this calendar. There's one other hot zone that I look for on the tradingeconomics.com calendar, and that's the API number on Tuesday afternoon. That helps us with the EIA if we're looking at that. So you'll see Waller at the close on Thursday, right? So Bostic, see now here is a speaker that wasn't listed on Forex Factory, and Bostic upended the intraday trend and added a lot of volatility this past week. So again, heads up on Friday. I know that seems far away, but this is the time to put that in. Bowman, Barkin. So notice that there are some FOMC speakers on the trading economics calendar that are not on Forex Factory. All right. You might say, well, Rog, why look at Forex Factory then? Because it's really easy to identify what the hot zones are by these red icons. And if you're brand new to try to discern, hey, what's a economic event that I need to be aware of? This is why I call these things hot zones, right? Because we have this nice red hot icon telling us, hey, manufacturing prices may not be a big deal, but the ISM manufacturing PMI is. So it just makes it easier to decode their impact, their value to us as understanding these highly volatile times of the day. And also thinking about looking ahead to what they could mean. Sometimes the overall movement in the indices and bonds and euro can go into wait and see mode when we have a high impact hot zone coming up. All right. So let's get to our questions. And I do want to let everyone know, because I've gotten some emails as far as Rog, I didn't catch the webinar you did last Thursday live. Where can I catch it? You can catch it over at simplertrading.com/auto. All right. So with that being said, let me jump on over to, now, by the way, I have got three different layouts here, right? I know all the buzz is about the DPMRs and short-term swing trading, but I want everyone to know, gang, never a session, a day, a trading moment goes by that I'm not looking at three different layouts. The first one here you can see is volume max, V-score, anchored VWAP, V-score bands, V profile. The second one, this is the one that's been with me the longest. It's the tops layout, grab, wave, propulsion, Darvis. I've got the sector slow still on here in the multi-trend. And then the one that y'all have probably noticed is sort of the new addition. And not really, because we've had the HPMRs for our day trading, because that is what they are for. And then now we've got the HPMR sort of, big brother, big sister, however you want to look at it, in the DPMR. So I'm always looking at a single symbol, but through three different ways of measuring what's going on. So if there's ever a time that you say, Rog, can we have a volume breakdown? Oh my gosh, I'll take us right on over to volume max. Rog, can we have a trend breakdown? Right on over to tops. Rog, can we have a price movement range, volatility breakdown? Of course, enter HPMRs and now DPMRs. All right. Okay. So first up is AMAT from I Am Groot. All right. What's the first target? What's the T1 if I bought calls this week in the wave on the daily chart? So talking about the wave, that would take us over to our tops layout. What's going on with the 34 EMA wave? I'd keep an eye probably initially on 119.5 if you want to have sort of a closer optional type target. If not, say 124 and change is absolutely fine. Yeah, could you do a Pingala, that 50% retracement? Absolutely. That's always a really effective way to look at what is a realistic level in which to touch. Yeah, I think that would be fine. All right, next up, when trading on the hourly, should I be using the HPMR or DPMR on my screen? John, terrific question. So let's go on over to that layout. Okay, so here is what we're looking at, which is the HPMR, DPMR layout. John, for the most part, my approach is not that on an hourly chart, I'm not thinking day trade, right? When I'm looking at hourly chart, I'm thinking that I want a short-term swing that has a high probability, not certainty, of course, but a high probability of taking the trade overnight, right? So with that in mind, I want the daily price movement levels. I want something that's studying session by session by session, not hour by hour, because the hour by hour is going to put me more in a day trading type expectation. So I guess the first thing is asking yourself, are you day trading or are you short-term swing trading or just swing trading in general? If you want to be flat by the end of that session, regardless of the strategy, regardless of the time frame, that is in fact day trading, right? Being in the market for that day. And that's where I would say use the hourly price movement ranges. That's what they were designed to help decode the volatility of. Once we start saying, you know what, I think I want to be able to at least have the choice, if not planning to take a trade overnight, that's where the DPMRs come in. That's the short-term swing, which is a very, very different type approach to day trading. And that's when the DPMRs would come into play. And so I use DPMRs on the hourly because that's what we've tested, works so well. And I like day trading off a 5-minute time frame. So the HPMRs will be there. All right. And that's the way I break that up. Daily price movement ranges, the DPMRs are for swing trading, overnight exposure, and HPMRs are for day trading, being flat by the end of the day. All right. Okay. Next up is Happy Sunday. Absolutely. Thanks, Mark. All right. PP Family asks, Happy Sunday. Absolutely. SPX 500. Sure, we can pull up the SPX. Let's see. Is it a buy the dip at this point? So if I'm going to buy the dip, let's start with tried and true and our understanding of the market trend. What is the underlying psychology of the market? So the first part of this, is it a buy the dip, is simply no. But how do we know that? Rog, okay, how would I know that? Take a look at the very bottom of this chart. The trend is yellow. That means it's neutral. If I have a neutral trend, I do not have a buy the dip. So buy the dip is really synonymous with a retracement. It's a mean reversion. And a dip buy for me is only valid in a trend. So this is not a trend, so it's not a buy the dip, right? However, how about more generally, is it a potential buy, right? Let's take another look at it. So the trend that preceded the chop was up. Now it's sideways. Respect the trend that was. While this is chop, it is bullish chop, right? I have more of a directional bias to the upside. I would want to focus on oversold buys. I have my sector slow stochastic, nearly oversold. And in a neutral environment, a sector slow stow is exactly what I want to use for understanding where a market might be finding a floor or a ceiling in a range-bound environment. So that's what I would look at. I'd look at an oversold buy setup, preferably at some kind of Darvis support or some sort of pattern like a minor low that helps me out. And ideally, if I'm triggering a 20 reading on the sector slow stow. All right, next up, DXY. It has reached the target of 105.25. I don't know whose target that was, but if that was your target, cool. All right, so DXY has reached a target of 105.25. I think the bigger story on DXY would be getting above the 105 handle, taking out the 200 propulsion. That's the way that I would measure that. Is this a good level from where it would retrace or go sideways in between? PP family, are you asking if on December 26th, we know whether or not a symbol is going to move between 101 and 105 for the rest of the year? I think if you've been watching this show for a while, we don't do predictions, right? We react to price levels. So I'll be frank, nobody knows that. So next question. CPI, PPI, and PCE all came in hot. What's my overall view of the macroeconomic? Okay, so let's talk about that. In order to understand macroeconomics in this environment, it's really easy. I mean, it's really easy. And I don't say that to with any hyperbole at all, because right now we are in an environment where we're waiting to see what the Federal Reserve is going to do, right? What is the Federal Reserve going to do in terms of hiking rates? How high are they going to hike them? When are they going to stop? All of that can be at least measured, right? Can be measured with the Fed Fund futures. And this is where we head on over to the CME FedWatch tool on the CME. All right, so let's go to June. June is where largely we've been expecting the Federal Reserve to reach that peak rate at 5.25 to 5.50. Anything that suggests more hawkishness, right? And like July could suggest, would take us to 5.5 to 5.75. We can see that's possible in July. Come September, we're done, right? September says possibly we're done. Either June we peak at 5.25 to 5.5, or July we peak at 5.5 to 5.75. That's what's being expected or discounted or baked into the cake, as they say. So that's ultimately what we're looking at. Macroeconomically, the most important thing is that every word the Federal Reserve members use, every inflation number, jobs number, growth number, all of that maps to where does the Federal Reserve take rates, when, as in which meeting, and at what level, what percentage point do they stop? And I measure all of that using this graph right here. It's the easiest way to do it. Okay. And again, PP family, I love the question, but the second half of your question is it's asking someone in my position, what's going to happen? Let me say this emphatically to everybody. Nobody knows what's going to happen. If someone starts saying in 6 weeks, in 2 quarters, in November, in June, nobody knows. All we can do is look at, right, where we are right now. So I'm sure someone will answer your question, right? Which is, hey, are we going to roll? Who knows, right? I hope that makes sense, because unfortunately, financial media likes to parade all these, apparently, they can see the future. Apparently they're fortune tellers and not traders. They can tell you what's going to happen. I love something that Warren Buffett said in his annual meeting and in the notes, he basically said what I said. And if you don't want to listen to me, listen to Grandpa Buffett. Nobody knows what's going to happen. We play possibilities and probabilities. So I have no idea if we're going to go back into bear territory. My expectation, based on what we know right now, which is the broader averages, know what's happening in terms of the rate, a terminal rate, what it's often known as the highest rate the Federal Reserve is going to go to. Right now, we're expecting, right? This is not an unknown. We're expecting up to 5.75%. And the equity markets aren't rolling over and dying, as I guess we're told the fortune tellers like to say, right? So if this is what we know, right? If this is what we know, then I don't really think there's any reason from this standpoint, from a macroeconomic question of where's the Federal Reserve going to take the rates. There's nothing here that tells me there's any reason to panic quite yet. Of course, there's always the unknown, right? But let's focus on what we know and how the markets responded to what we know. I hope that makes sense. I hope that makes sense. And I say this because I respect everybody's time here. I would never sit here and ever say I know where things are what's going to happen the rest of this year or even 2 months from now. I'm not even sure what I'm having for dinner tomorrow, right? So we don't want to ever prognosticate. All right, next up, Robert asks, when using the HPMR, do you use other indicators to trigger an entry? Yes, of course. Yes. Do I have an opinion for Tesla this week? Sure, let's take a peek. Let's start with market structure. Let's jump on over to the tops layout and look at Tesla. All right, so what's the path of least resistance? Number one, it's up. Right? We have a trend that's been up since February 8th. Now I use moving averages to determine, hey, do we have key moving averages aligned in such a way that I would expect the path of least resistance probabilistically is going to go higher? Yes. Is there something in the way? Absolutely. Right around 220, we have a Darvis level. That's also the last level that we saw the 200 propulsion plot at. There is likely to be some overhead resistance in that area. By the way, right? By the way, look at it this way. If this is resistance, and my approach is to encourage folks to buy pullbacks in trends, right? If this is what we're looking for, like that, then just making it back to 220 could be a target. And that's why pullbacks are so effective, because traders who are looking for this breakout through resistance need higher highs to pay themselves. That's a very vulnerable place to be. That's not something I encourage. So I like that if we get a pullback. Now, do I know what the opinion is for the week? Again, not a clue. And neither does anybody else. However, the question really should be, gang, if we get down to this area, if we break this area, what can we expect? It's a very different way of looking at the market, gang. If we're always thinking that trading is about prediction, I would say 80 to 90% of traders think trading is about prediction. Listening to someone who's going to tell you where the market's going to be on Friday. I would also say that's probably pretty equivalent to the number of traders who lose, because they're looking at trading from a perspective of, it's my job to say where markets are going to be by a certain date. Right? That's like me telling you the score of the next ball game that's happening on Thursday or whatever. You know what I'm saying? We cannot prognosticate, gang. That said, what we can do is react, right? So don't worry about it, gang. Don't put the pressure on yourself of having to predict. If we get here, we know what we want to do. We want to focus on a long position. And that's a much easier way to get through the markets rather than forcing yourself to say, I got to predict where something's going to be, rather than planning for what you want to do when price gets to a certain area. And gang, that applies to DPMRs, HPMRs, the wave, the slow stochastic, Darvis. That's why all these levels are automated on the charts. So don't put the pressure of the impossible on your shoulders, which is, how can I see the future? I've never seen the future in my life. As I like to say as a trader, my crystal ball has been in the shop for 35 years, right? Don't put that pressure on yourself. You don't need to, right? You don't need to. The market historically does well with higher rates. What's the problem? Okay. I'm not even going to go there. We saw what happens when money is cheap. The equities like cheap money. But iPod Touch, yeah, go for it. Is it correct to say that the market has discounted um, only to a certain degree, right? That's why those columns show a percentage. It's not the higher probability. Correct. Okay. Next up, do I currently have a bullish or bearish bias? Yes, I'm bullish on the indices, but it depends on the market, right? And do I trade differently when the market has a minor counter trend? So let's talk specifically about markets, right? Which is a habit that I try to break as well. There's no such thing as the market. Although I think generally when we all use the word the market, we're talking about stocks, right? And more specifically the indices. But which one? S&P, NASDAQ, Dow, Russell, DAX, right? CAC 40, whatever. I know it's usually the S&P, but I think thinking in terms of a specific symbol is the first step. So with the S&P, I'm bullish. The daily time frame is bullish. When it comes to the NASDAQ, I'm bullish. However, it's no longer in an uptrend. Notice how the NASDAQ is starting to go a little neutral. The S&P is still very much in an is it in an uptrend? No, last week broke it. So now we're neutral. So no buy the dip. However, let's go back to respect the trend that was. And the Dow's been neutral for a couple of months now. The two things that I'm going to look at most carefully to have a bullish or bearish bias. So here's the how-to, Chris. Are we above or below the propulsion? And what was the trend that preceded the chop? That's going to help. That's going to help a lot in terms of whether or not I look at a chart and think, where's the general sentiment? And oftentimes being above or below the 200 exponential or 200 simple is going to give us that bullish or bearish. Above bullish, below bearish. So think of it, I like to think of it as the equator, right? As the equator. So I think equity markets are generally bullish, but then we have to look at another couple of markets, Chris, right? 6E and ZB. What is the euro doing? What is the bond market doing? See, bonds could be tricky. The bond market could be tricky. In here, ultimately, what we have is a lot of red grab candles in a neutral oversold environment, but well below the 200 propulsion. Where yields are going next is a big deal, gang. Generally, equities like lower yields. We've seen that for a long, long time. And we know that as bond yields drop, as high as corporate yield, junk, HYG, JNK, TLT, when these are lower yields, it's more enticing to grab risk assets like equities. And that in turn helps stocks and the stock indices, right? So generally speaking, equities like cheap money. It's just that simple. Anytime you see generally a fairly accommodative monetary policy that does then entice traders and investors to look at equities for a return. That's really it. So I'm bullish the equity markets, but we have a couple concerns. We want to see yields continue to move lower, which is to say we want the TLT or the ZB futures to move higher. Same thing with the IEF and the ZN, which is a 10-year. And I think it's going to be very important that the 6E hold the support of the 200 and move higher, because that means the US dollar is moving lower. This has an inverse correlation to the US dollar. I think it's going to be very important to see dollar weakness resume. And that would mean continuation from what was an uptrend to now chop, and seeing the 6E remain above that 200, right? So those are all the pieces that I'm looking for. All right, Mr. Walker says, I heard the like button is free. Absolutely. Leave comment, leave question, leave request, whatever you'd like. Mr. Walker, you cracked me up. It sure is. No, I appreciate that. New here? Well, welcome. All right, Bank of America. Sure. So we had two stocks from the XLF that was on our radar. One was Bank of America, right? And the other was Wells. Now, Wells is a relative outperformer. We have long positions in both. Bank of America is still a long position, had a great Friday, but we did take a little bit of heat. I will say we took a little bit of heat. Wells has took nearly no heat. That's what a relative performer can do. So we like them both to the long side, but I like Wells better, Mr. Walker. When you take a look at all the different stocks within the XLF, let's do that together, shall we? We take a look at all these stocks in the XLF, Morgan, American Express, what's mostly green grab candles, what's above the 200, what was trending higher, even if it went into chop. Citi looks enticing. There's a lot to like here, but Bank of America took a bit of a tumble. We took some heat on that. Heat, by the way, meaning unrealized loss. And I think we actually scaled out of the aggro and the moderate, which is to say we took a small hit. We're going to lose sometimes. I like to be really honest about those things. We can scale out of certain legs of the position and still keep a conservative leg. But Wells Fargo is doing quite well. So I like Wells better. Mr. Walker, I do like Wells better. Do I have any thoughts on UNG? At this moment, I do not. No, it's still moving lower. And I don't necessarily believe that it's time to get too bullish yet, even though the seasonal is in play. We'd like to see it go neutral on the NG, and then that will give us some clarity on the UNG ETF alternative. All right. Next up, Jack says, thank you for discussing the 60 and the ZB. You answered my question. It appears the ZB is trying to bottom out. That's a really good question and or talking point. So let's dive into that a little bit more. If I'm looking at ZB, couple things that are going to catch my eye, right? Reaction levels. Well, let's take a look at the last time we were here. And what's here? Here is this Darvis support. See that? So I'm using this purple automated line called the Darvis 2.0. Pull that forward. We've been here before, right? Last time we were here, neutral, slow stow signal. Here we are again. Slow stow signals, still neutral. It would make sense that setup in this environment is more likely to bounce. Right. Now, could it break down? Absolutely. With the kind of FOMC speakers we have, with the kind of data we have, certainly if we see another ratcheting up of expectation of more hawkishness from the Federal Reserve, yields are probably going to go up, which is going to send TLT in this chart right here, the ZB lower. Absolutely. All right. So that's something that we're definitely looking at. Are we going to be doing this at 6 or 6:30? And I've been going between the two. We've been doing 6 for the last month or so. So check the Simpler Trading YouTube channel, but we've been doing 6 o'clock. Yes. All right. GLD is refusing to go higher. It is, isn't it? Rohan, it is. And why is that? Well, one, we haven't attracted buyers yet. We've broken the uptrend, which means buy the dip is no longer viable. So that trend was broken, right? You can see that in here. Now we're looking for support. The 200 this week could be very interesting. And then the other thing to remember is real yields, the nominal yield of a bond minus the rate of inflation. If I'm not sure where bond yields are going, and we're not sure where inflation is heading, or at least what the Federal Reserve is saying about inflation, there's going to be a lot of confusion about gold. And I think that's exactly what we're seeing. Okay. All right, gang. So I think that's it for the questions. As always, thank you so much for being here for the Raghee Report. If you haven't checked out my latest webinar class, it is available at simplertrading.com/auto. I will see you all tomorrow, same time, or not same time, same station, 9 a.m. for charts and coffee. Be good to each other, gang. Thank you as always for being here for the Raghee Report. Thank you for your questions, and I'll see you next time.